Political events can have a strong impact on financial markets. We're only 2 weeks away from the first round of voting in the French presidential election, and volatility is making a comeback. Far-right candidate Marine Le Pen doesn't like the euro, and she is also widely expected to go through to the runoff on May the 7th. If opinion polls are to be believed, she won't become president. However, some of the runoff scenarios are likely to cause more volatility than others. In probability terms, the independent candidate Emmanuel Macron, who supports the euro project, seems best placed to face Le Pen in the second round and actually beat her. By contrast, a runoff between Le Pen and any other candidate is much more difficult to call. And so it's likely to pose bigger downside risks for euro-denominated French and peripheral assets until the election results is finally declared. Later in the year, Germany also goes to the polls. A lot of media attention has been given to the far-right populist party, Alternative für Deutschland. It certainly makes for good headlines, but the reality is that support for this party has hardly ever gone beyond 10%. And within the context of the German electoral system, that only guarantees a role as a fringe opposition party in the Bundestag. That doesn't mean that Merkel is a shoo-in for re-election. Support for the Social Democrats has rocketed since the election of Martin Schulz, the former president of the European Parliament, as their candidate for the election. And so the surprise in Germany in the autumn might be that Merkel is beaten, but she won't be by far-right populist, but by the Euro lobbying Horst Schulz. So when hedging against the risk of a populist wave against the euro, one should also perhaps entertain the very serious possibility that 2017 might end up with two very staunch euro supporters holding the reins in Berlin and Paris.